Hello and welcome to Portfolio Matters, week 13 on the 1st of April. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, we're doing it today because tomorrow in the UK is a bank holiday.
Absolutely. And not just because it's April Fool's Day.
No. And also, I think we should point out that none of our slides are designed to fool anybody.
That is true. Okay, well, the big news of the week is we have some details of the Biden infrastructure bill. Now, this is proposed to be 2.1 trillion over 10 years, so an extra 200 billion a year, and it will be paid for by reversing the Trump corporate tax cuts. Remember that Trump cut the corporate tax rate from 28 to 21%, and also by raising tax on people earning over 400k. And it will be spent 621 billion on infrastructure, that's roads and bridges, etc. 174 billion on electric cars and creating a countrywide charging network. There'll then be 400 billion for affordable community-based care for people with disabilities and 213 billion for improving the energy efficiency of homes. Now, the Democrats are saying that they are hoping to get some Republicans on board and to get it through the Senate. But they're also saying that they may be able to get it through the Senate without Republicans, with the casting vote of the vice president. And Nancy Pelosi wants to get this bill passed by the 4th of July. So this is all adding up to enormous fiscal stimulus this year. And we should also add that this infrastructure bill of 200 billion a year is only part one of the Biden administration's Build Back Better plan. And part two, which aims to help families, is due to come in the coming weeks. So,
Keith, I heard someone commenting on it this morning. Apparently, the spend will last for 8 years,
yeah.
And the tax increases will effectively cover the spend over 16 years.
Right. Okay. Well, there's a wall of fiscal coming. Richard?
That's an interesting graph. So last week we talked about the dollar. I think actually we talked about it in our interest rate discussion, didn't we, Keith, about how the dollar was dropping as a share of global reserves. And this graph shows it really clearly that since the early 2000s, the dollar has effectively been on a steady downward decline in terms of the share of global reserves. The problem with that is, of course, that just at the time when the US is looking to issue more debt, countries around the world appear to be buying less US debt and putting less into their reserves, which means that the US government will have to find another purchaser, not only for the debt they're going to be issuing, but potentially for debt that other countries no longer wish to hold. So that's going to put a lot of pressure, I think, on the Federal Reserve and the US system to fund this debt.
Absolutely. And we've seen in previous weekly updates how China has actually been a net seller of US treasuries in recent years. It's completely stopped buying.
Yes. SPACs. So as we've heard, across the Atlantic, SPACs, special purpose acquisition companies, have been the great way to make loads of money. In case you don't know what they are, effectively a shell company, it's floated on the stock market. It's funded by an issue of shares to the general public, and then searches around for a private company to buy. So effectively, it takes a private company public through a non-IPO route. And there's been a lot of froth associated with these. And in January, the average first day return was, is that 6.1%, Keith?
That's right, yes.
Yeah. In February, it was 5.4% first day return. And in March, effectively, there's no first day return. Now, the issue with this, I guess, is that the public is investing in the hope of making a killing. The people running the SPACs are making a killing out of fees. And the company that's purchased into the SPAC, the owners do very well out of it. But whether the value is present in the business remains to be seen. And I think if we move on to the next slide, Keith. This is the proposed WeWork SPAC. So it's to go public in a $9 billion SPAC deal 18 months after its IPO collapsed. And just a little bit of the finances of WeWork. It has revenue of $3 billion, annual revenue of $3 billion, and an annual loss of, $3 billion.
$3 billion.
Well, that's a surprise. So why is a company that makes $3 billion in gross revenue, loses $3 billion, and it basically owns office buildings, why is it valued at $9 billion? Goodness knows, in my view.
Absolutely. And of course, in the UK, we've had the Deliveroo IPO, which just seems absolutely ludicrous to me. Tried to value it at 7.2 billion. I mean, it's still valued at 5.9 billion after a bad first day. But it's a company that loses money in a highly competitive sector, and
also
high court.
Once the country opens up and restaurants and dining open up, presumably the demand for Deliveroo service will fall.
Absolutely. But also the High Court has ruled against Uber.
Yes.
And said that, these are not freelancers, they're employees and they need to be treated as such.
Yeah.
So I just can't see it.
No.
I think there's a lot of froth in this market.
So recently we've come across, and we've shown you quite a number of graphs which suggest that there is a lot of pent up money waiting to be spent after lockdown. And interestingly, this graph shows the opposite. So we thought it would be good to point this out. Effectively, it's showing that in February, the month-on-month change for US personal income was a significant drop. Now, that's just before some of Biden's largesse. And the month-on-month personal expenditure, consumption expenditure, also dropped. So this is slightly at odds with the concept that there's a lot of money sitting on the sidelines waiting to pour in to the service sector and personal consumption. We shall see, but I think that situation is probably not binary and is very complex.
I agree absolutely with that, Richard, but I think we covered this as well last week when we saw the Fed's real-time GDP estimates taking a knock. And I think this is more evidence of that. Something happened in the US. Maybe it was this cold weather spell that has knocked consumer spending.
It's a good point, Keith. Yes, I'd forgotten the real-time survey.
Yeah. Okay, so the other big news of the week was the extraordinary failure of this hedge fund in the US. I think the pronunciation is Archegos.
Archegos, Keith.
Yes. Yes, which I believe means the one who leads. Well, he's led the markets a merry dance, basically. So this was a billionaire Chinese investor who had taken out derivatives positions with lots of banks specializing in both Chinese and US technology companies. And late last week, the banks issued him with what was being described as the world's largest margin call. And they said, unless you stump up more margin, we are going to liquidate the portfolio. And they then proceeded to liquidate the portfolio. And you can see the effect here on Viacom, which is one of the big stocks he held, and the share price absolutely cratered. Now, I find this whole
I was just thinking, looking at that, I don't know when Archegos began purchasing Viacom shares, but it was January. You could argue that they were entirely responsible for the rise in Viacom between January and March.
Yes, I mean, that is also being said.
Isn't it?
Yeah. And so it was being said that he made an extraordinary amount of money, but then it was revealed that he was the market.
Yeah.
Now, what I find extraordinary about this story is that you should never commit to a trade where there's any chance that it will completely destroy your wealth. If there's a trade where you have a 99% chance of making 10 million and a 1% chance of losing everything, you should never take that trade, because if you get taken out of the game, there's no way back in. So for somebody of his wealth to essentially lose everything, I think is absolutely extraordinary.
Yeah.
And now, the other thing is, I've read quite a lot on what happened, and I've got contradictory stories. So there are a lot of people saying that he was hit by this enormous margin call, but I think the most convincing argument I've heard is from Ben Hunt, who was saying that what he thinks happened was that Archegos had lots of these derivative positions betting on the same stocks with half a dozen different Wall Street banks. And because they were derivatives positions, they didn't have to declare them to anyone. And so each of the Wall Street banks thought that all the positions were with them. And then suddenly they discovered that he had duplicate positions with lots of other banks, and they'd completely misread how much risk he actually had. And then when they realized that, they demanded more margin out of him. And when he couldn't meet the margin call, then they liquidated all the positions into the market, causing these extraordinary downfalls.
And he didn't own the shares, did he, Keith? He owned derivatives of the shares, which
exactly.
He didn't appear in the shareholder registers, and he didn't have to declare what his holding of these companies was, which under normal, if he owned the shares, his holdings would have been publicly available, and everyone would have known the level of his exposure.
Precisely. Now, moving on, this is a chart showing the correlation between different asset classes and US inflation since 1950. Now, I think this chart should be treated with a bit of caution, but it's interesting. And what it shows is, as inflation picks up, you should be in commodities, platinum, real estate, diamonds, gold, collectibles, UK farm, T-bills. I don't really understand that. That seems completely counterintuitive to me. But anyway, real assets.
Yeah.
Stocks actually haven't done terribly well. I think it's because when inflation really picks up, stocks do very badly. So in the 70s, rising inflation caused a big sell-off in the market. And then negative government bonds. As inflation picks up, you don't want to be long bonds.
Yeah.
And this is a chart showing the input prices in the US, and they are showing the Philadelphia Fed and the Richmond Fed both registering very strong rises in input price inflation. And if you look historically, those rises have tended to persist for some time. So when the Fed is saying that they expect any inflationary pulse to be transient, I wonder.
It's also a steep rise, Keith, and it's continuing. It is still on that sort of 60, 70 degree upward trend at the moment. So it hasn't reached the top at all. So
yeah. Yes, absolutely. The other thing is that the US has become increasingly concentrated in terms of large companies having an increasing share of the market. So increasingly monopolistic. And Richard and I read a really good book called The Myth of Capitalism by Jonathan Tepper that goes into this. And what that means is that industries are now dominated by perhaps 2 or 3 big players. And because it's increasingly monopolistic or oligopolistic, they have pricing power. And also, they have monopsony power in paying for staff. If you think of Amazon, etc., they can impose terms on their staff. And so this all means that businesses will have the power to pass on input price inflation to their customers because there's a lack of competition.
I have to say that book was it's a very interesting. We thought it was a well-written book. It was quite disturbing in its conclusions. So if anyone is interested in reading how damaging monopolistic behavior can be, I think we would recommend it, wouldn't we, Keith?
No, absolutely. I thought it was a really good book. And this chart looks at the interest cover of US corporations. So how much their earnings cover their interest costs. And what it shows is that despite these historically low interest rates, during the good times, the banks massively increased their gearing so that actually their interest rate cover fell over the last 5 years. So they're very highly geared. So this is a warning that if interest rates rise quickly, you could see quite a lot of financial distress.
Yep.
And this is just a chart showing UK deaths compared to the seasonal average. And right now we are below the seasonal average. So deaths in the UK are better than normal. So we should be rapidly getting back to normality, I hope.
And so this is a couple of graphs showing UK economic forecasts, which have proved overly pessimistic over the last 6 to 8 months. So the dark blue forecast, the grey is actual, and you can see how, for example, November forecast was for almost -6% GDP growth, whereas it actually came in at -2. The same thing has happened in January. So the UK economy has withstood the effect of lockdowns better than economists were forecasting. And actually, I'm glad to say, better than I was forecasting. And the UK Economic Surprise Index, where data is better than expected, is relatively high. And having gone through that awful dip back in March, April time, it is now at a, I would say, a fairly optimistic level, which suggests that the UK economy, given that we're about to exit lockdown, hopefully forever, is ripe to show some significant resurgence.
Right.
And unemployment forecasts are being revised down for the same reason. And that's good news too, clearly. So this is more on Keith's inflation theme, which shows that all of those Federal Reserve banks, Philadelphia, New York, Dallas, and Kansas City, have recorded significant increases in raw material prices, and that the US 10-year break-even rate is indicating that inflation is heading for 2.5% and quite possibly higher. So a lot of indicators suggesting that inflation is on its way. What it doesn't tell us, of course, is how high it will go or how long it will last.
Okay, and moving on to the weekly checklist. Markets. Well, markets had a decent week, actually. FTSE up 1.2%, S&P up 2.6%, NASDAQ up 2.1%, despite the continued rise in yields. Japan Topics was down 1.3%. Bitcoin had an amazing week, up 10%. I will leave it to Richard to cover that in a second. And sterling was flat.
Well, as Keith just said, Bitcoin has recovered from the swoon it took down to 50,000 and is almost back up to the all-time high, just above 60,000. Clearly, it's going through a period of consolidation. Clearly, the sort of meteoric rate of rise that it experienced from last November up until the autumn, and then again from the late autumn, well, indeed from February up until beginning of March, has slowed right down. But I think that there is a groundswell of interest that is maintaining, and personally I believe will gradually cause the price to continue to go up for some time, to do with decentralization and the disintermediation of the economy. Keith is smiling.
Yeah.
Doesn't believe a word of it.
So far, Richard, I've been wrong. You know, you've clearly made a lot of money out of this, but I think it's a huge Ponzi scheme.
But as I point out, Keith, I have reduced my holdings by 2/3. Yes. So my conviction is less than it was, I can assure you.
Yeah. Well, it's also using more electricity than Belgium. It's just ludicrous. Anyway, never mind. Carry on.
Same with Ethereum. Nothing much to add there, Keith. Thank you.
Right. And seasonality, one of our favorite themes. April is a strong month. So on average, the S&P is up 1.4%. So stay invested. Moving on to the checklist for industrial commodities. Aluminium was flat. Cobalt was down 3.4%, but coming off its recent highs. Copper maintained its highs at up 0.8% on the week. Iron ore was also strong, going back up towards its highs. Lithium and neodymium both were flat. Neodymium is again maintaining recent highs. Nickel recovered slightly. Nickel's had a bad month. Ferrovanadium continued to come off. Oil was flat on the week after having quite a lot of volatility. And uranium had a great week. Richard, do you want to talk about uranium?
Yes, thanks, Keith. So uranium, I think this is an interesting one. So I'm a bit of a uranium bull in the sense that I think that there is going to be a sudden, quite rapid shortfall in supply in due course. This is a story that's been knocking around for probably 4 or 5 years now, and it hasn't come to pass. This is just a short-term chart showing how it's moved from 27 to 31, which obviously is like a 30% increase over a short space of time. If you go to the next slide, Keith, we've got the long-term chart. So this is where uranium spiked up to 140 in 2007, 2008. And you can see it's been a long, miserable journey all the way back down to 20 since then. And if it is moving into a new bull market, it is clearly at the very early stages of doing so. But I think the fundamentals are probably in place for that to happen. Whether this is simply another wiggle in the line, in the price line, and I think you have to be careful that since 2017, you could say this is it, this going, but actually it hasn't been it, and it's not going. So timing on this one, I think, is impossible to tell, but definitely one to watch.
Right. Okay. Cobalt is coming off its highs, but they're big highs, and it's only just come off. And I believe it's actually picking up again today. These are figures as of yesterday night. Moving on to oil. Now, as regular viewers will know, I own a lot of oil companies. And one of the main reasons I am very keen on oil is shown in this chart. And what this shows is the investment of the oil majors. And you can see that it's massively declined from its peaks in 2013, 2014, when the oil price was much higher. And so nobody is investing in finding more oil. And so we still need a lot of oil. And going forward...
I read the other day, it was yesterday, that BP have cut their exploration team from 700 to 100, and they're my interpretation was they're redeploying that team to hydrogen.
Oh no. I own a lot. That, yeah, God, I own a lot of BP. The more I hear about BP, I think they've completely lost the plot. I mean, we'll have to look into hydrogen, do a special on
I think
hydrogen.
you should do, yeah.
But the trouble is, all the stuff on hydrogen I have read is that it's just not economic.
I think we should do a special on it.
Yeah. Anyway, so going back to this chart. Yeah, what this shows, nobody's finding the stuff anymore. And this shows car travel in Israel, where they've done an absolutely amazing job, and they have vaccinated essentially the entire population at least once, and they're now going around on the second round. And as people have the vaccination and lockdown eases, they go driving. And so you'll see that there's more than 25% more driving now than there was pre-lockdown. And this is the chart for the US, and you can see that the petrol demand is almost back up to where it was pre-pandemic, but the trajectory is definitely rising. And last week we covered the fact that there were strong inventory rises in the US, which suggested there was an oil oversupply. Well, this week there's been a small draw. So now moving on to our regular debate about whether vanadium redox flow batteries are getting any traction. I did some digging on the internet this week, and I found this amazing database from the US Department of Energy called the Global Energy Storage Database. If you're interested, it's freely available online. Isn't the internet wonderful? And it contains details of every energy storage project since the 1950s. And if you start digging around in the data, it shows that these figures are quite small. So I'm going to just concentrate on the top, where you can see lithium-ion batteries down to vanadium redox flow batteries at the bottom. So pumped hydro storage dominates. But lithium-ion batteries have been installed with a rated power of 2.65 million kilowatt hours, although the average duration of those, the length of time those batteries can run for on average is 1.7 hours. So that you could run that 2.65 million kilowatt hours for 1.7 hours on average. And then at the bottom here, we have vanadium redox flow batteries, and there's 55.8 thousand kilowatt hours, which can be run for an average of 5.2 hours. So the power rating of installed lithium-ion batteries is 47 times greater than vanadium redox flow. Although vanadium redox flow battery projects that have gone into operation last on average 3 times longer than the average lithium ion. But those figures exclude this enormous vanadium redox flow battery in Dalian, which has a rating of 200 megawatts to run for 4 hours, and on its own is the 10th largest energy storage category. So anyway, evidence that currently vanadium redox flow batteries are only getting a small fraction of the traction of lithium ion.
Interesting, Keith.
Moving on to precious metals. Precious metals had another bad week, although even though gold has bounced quite strongly this morning. So gold was down 0.9% on the week. Silver was down 3.4%. Platinum recovered a bit, up 1.9%. Rhodium fell 7.1%. and palladium is flat. Richard?
This is a long-term chart of gold, and what it's showing is that from the rise of began in the middle of 2018 up until the middle of 2020, from 1200 say to 2072, has actually been retraced from a Fibonacci point of view to between the 38 and 50% retracement, which is actually, in the scheme of things, is actually a relatively small retracement and doesn't indicate that gold is doing anything other than retracing after a fairly significant rise of about 80% over the previous 3 years. And so bullion by post, I said I'd only put this one in if something changed. And what's changed here is that the larger bars, 500 gram silver bar, 5 kilo silver bar, are awaiting stock. Although the 1 kilo silver bars and 100 gram silver bars are in stock. I don't rate 10 ounce silver bar particularly important. So the question is, are the larger quantities of silver out of stock, and does that indicate a shortage? I don't know, but that's what I like to keep my eye on. It's a little indicator of what might be happening in the silver market.
Interesting. But silver's been coming off. The price of silver's been coming off.
It has.
And
this is Keith's chart, and he's called it another dodgy gold chart, but he's actually taking the mickey, I believe. But Keith, explain, please.
Well, we seem to do another dodgy gold cut chart every week, and essentially, there's all this overfitted data, but what they all have in common is that they show a strong correlation between rising yields and falling gold. So as in fact, this is a really terrible chart because gold's inverted. So it's
actually impossible to work out what's going on, doesn't it, Keith?
I think it does, but
this is one of those correlations that will work very well until it breaks.
Yeah, well, that's right. But anyway, all you need to know is rising rates are bad for gold. As is Bitcoin, Richard.
Well, basically what this is suggesting is that people are moving out of gold and into Bitcoin because they see Bitcoin as a better, easier, more manageable store of value than gold, and that they'll be better off in inflationary times with Bitcoin and with gold. I mean, that is not why I'm interested in Bitcoin personally, but I know it is a view that people hold. I would suggest that if there's power cut, you can go out and spend the gold sovereign. I mean, you might have trouble spending it in Sainsbury's if you walk into it, but you certainly won't be able to spend your Bitcoin if there's a power cut. So, I think it's...
Anyway, but it seems that people... Certainly there has been big inflows into Bitcoin.
Yeah.
That's what you can say.
Yeah.
This chart of rhodium, which came off but is still very elevated. Holders of Sylvania Platinum, I don't think need to be too worried. Okay, moving on to rates. Well, having dipped last week, this week, rates resumed their rise, and there was actually quite a strong rise. So you see, we had rises across the curve and particularly at the long end. And the 30-year, during the week, the rate on the 30-year rose from 1.25% to 1.36%. That is a big jump. And if we move on to these charts, you'll see that over the course of the last month, actually, you could say the UK 30-year interest rate has been flat, but we fully expect it to keep on rising. And when you look at the performance of bonds over the last quarter, US Treasuries had their worst quarter since 1980. And if inflation continues to pick up as we expect the sell-off in Treasuries to continue. And these are the US 10-year Treasuries yield, not gilt yield, Treasury yield. And you see on a 1-year view, you're getting frankly, a steady rise. And on a 15-year view, you'll see that US 10-year rates are now essentially back about where they were before COVID-19.
Thank you, Keith. So my portfolio review, weekly change up 1.3%, 4.7% for the year. Purchases, I bought some more ferroalloy resources. I must not buy any more. I must stop now. I bought some more Geiger Counter, which is an investment trust that invests in the shares of uranium miners, which we discussed earlier on. So I bought a few more of those. I sold shares in the cannabis. It's one of the derivatives of cannabis. It's not the addictive stuff. Elixinol, which is an Australian company, and I sold them for a loss of 55%. And I think this might be one of my worst trades in due course. I also sold my coffee ETF, which I proudly told you about last week, because it lost 1%. And my logic was, well, I think coffee's going to go up because there's a shortage, and coffee didn't go up. So I'm assuming that my information is wrong or out of hand, and everyone else knows more than I do. So I got out of that one pretty quick.
Well done. So
this is a graph of ferroalloy, and again, this is a Fibonacci. So it had a big jump from 10 to 44.69, and then it retraced between 50 and 61% retracement, and then it's gone back up. And the idea of the Fibonacci's, I think, is it just gives you, as I said earlier, it gives you a little bit of a feel from where you are in the ebb and flow of a share price. Now, if it follows the Fibonacci, what it should now do is go back above the high at 45 and probably carry on for another 10 points or so up to about 55 before it then starts to drop back. Now, we shall see whether it does that or not. But again, as I say, it just keeps me comfortable in understanding my position. And Hexa Mining, which I bought last week, proceeded to go down. I'm actually down about 8% on it. I was yesterday, although it had a bit of a bump yesterday, back up as the price of silver. So my timing for Hexa Mining was not great, but yeah. I'm hanging in there. And this is the graph for Geiger Counter Investment Trust. So at the peak of the uranium price, it was at around about 3 times the current price. The uranium price there was $140 a pound. I don't really know what the potential is, but if the uranium price goes up, there is a significant potential for Geiger Counter to go. Incidentally, look at this perfect head and shoulders on the left-hand side of the screen. Perfect shoulder formation.
I'm almost convinced, Richard.
Then I just came across an article about ETFs, which I just thought it was quite interesting. I pulled out some of the key points that it was making, which I think are very valid. It was talk about particularly specialist investment trusts. So some funds with narrow and specialized investment objectives can amass large holdings in companies that are barely traded. And there was some research was done by FactSet, which came on this. So this can be hard for the investor, such as Keith and myself, to spot. And when the ETF is sold, the investors might never know if there have been problems in performing the trades, because we don't see what the ETF manager has to do in order to buy and sell the underlying stocks. So this company, FactSet, measured how much trading in an ETF's underlying stocks would be required if investors were to sell enough shares to prompt a redemption of 5% of the assets under management. And so in these fairly specialist companies that invest in fairly thinly traded underlying shares, the iShares Global Clean Energy ETF, the necessary portfolio trades would equal 36% of the recent medium trading volumes if there were a 5% reduction in the total assets the ETF held, which is an extraordinary amount. So 36% of the trading volume for one ETF to exit 5% of its position, which suggests adverse price impact is more likely with funds that hold outsized positions in less liquid markets. And it identifies potential problems with ETFs, specialist ETFs tracking silver miners, rare earths, cannabis, renewable energies. So basically, if you are going to invest in a specialist ETF that will, invest in its turn in thinly traded, somewhat illiquid markets, understand that you may not be able to get out as easily as you can get in, and therefore you need to size your position accordingly. Thank you, Keith. That's me.
Okay. Thank you, Richard. Okay, well, I only had one sale this week, and it's I bought a bit of Metal Tiger. In fact, I bought all the UK listed mining royalty companies some time ago when Richard alerted me to the fact that this sector existed at all. And obviously the performance of Franco-Nevada has been absolutely astonishing. So I thought, well, I'll buy a bit of these and analyze them as we go along, just in case they all go through the roof as metals prices rise. And when I analyzed Metal Tiger last week, I thought, I don't want to hold this long term. So I sold it, and it's extraordinarily liquid, and I lost a bit of money. But, there you go. So I had an okay week, not helped by oil. Essentially, oil producers, BP, had another poor week. And if they keep on switching into hydrogen, I might have to do something about BP, actually. Which takes me up to 2.2% on the year. So I'm underperforming the all share, although, of course, I massively outperformed the all share last year. So not fussed. And I only had one buy, which was Touchstone Energy. Touchstone Energy had a bad day. Was it yesterday or when they announced
Tuesday?
Tuesday, when they announced the results of an appraisal of their last well, which turned out to be not gas, as they'd told the market, but oil. And the market took this very badly. And the share price fell 30% on the day. And I should stop doing this, actually. I was so excited I bought some at 96, and it's now 91.
Well done.
But anyway.
And hopefully they will resume their upward march shortly.
Well, so I bought a market position because my attitude is you don't really care unless you've got a position.
Yeah.
So I've got a small position, but I'm not going to add to it until I see what happens.
Yeah.
Essentially, they have they're appraising the other wells in 2 weeks' time. They'll get results, and I also will cover Touchstone Energy in due course, having now bought some. Like Richard, I just wanted to highlight Ferroalloy has had a good week. Petrometad has not had a good week. It is the last day of the quarter, and the exploitation license has still not come through. I mean, frankly, I just can't see any reason why the Mongolian government wouldn't want to give them this license. But the reality is they ain't. And if they don't give them their license, the shares are probably worthless. So there's downside. I just can't imagine why they wouldn't give the exploitation license. But so far, it's not forthcoming. Interested viewers should obviously watch our share talk on Petrometad, where we talk about the company in some depth. And that is me done.
Great. Thank you very much for that, Keith.
So, thank you all for watching. I hope you enjoyed that. Please, can you press like and subscribe to our channel? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website. including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.